You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to the Investor Way with me, Sam Ball. It's the 2nd of February 2025, and I'm joined by my co-host John McEwen. In this week's episode, we'll be discussing Persimmon, Games Workshop, Taylor Wimpey, Fevertree, Experian, and Netflix. John, do you want to start us off with our first house builder of the week, Persimmon?
Yes, so it's the York-based house builder, and they had their Q4 trading statement out. It was a couple of weeks ago now, but Persimmon's full-year average weekly net private sales rate rose 21% to zero point 0.7 due to demand being consistently higher than prior year since spring. Completions were ahead of market expectations, up 7% to 10,664 new homes, and average private selling prices were broadly flat year on year at £287,150. The order book grew 8% to £1.1 billion, and the net cash position fell from 420 to around 260 million due to increased land spend and continued shareholder returns. Full year underlying pre-tax profit is expected to be at the top end of market expectations, between 349 and 390 million pounds. Heading into the new year, the group said it was mindful of the timing of future interest rate changes and the effect they may have on consumer confidence in the near term. Build cost inflation is expected to be in the low single digits this year, and the shares were up nearly 5% in early trading. In terms of valuation, Persimmon has a market cap of £4 billion and trades at 0.95 times forward price to book, compared with a 10-year average of 2, and it has a prospective dividend yield of 6.2%. I thought these results were very good. I think you are now definitely beginning to see the cycle turn and things becoming a lot more positive. I think there is some caution there, though, that interest rates are still looking like they're probably going to be higher for longer. There is talk about recession in the UK. There are additional costs in the form of national insurance, which are going to feed through. So I wouldn't be totally bullish that it's going to be, smooth rise going forward. But I think that, as we've talked about lots of times, the structural trend and the supply-demand imbalance in the UK has got to be good for Persimmon and the big house builders, and they are sure to capitalise on that going forward. I've owned Persimmon before, I've owned Taylor Wimpey before, I currently have Redrow. They are certainly a bumpy ride along the way, and I've probably had them for getting on for 10 years. But I think, as we've said before, they are much, much healthier businesses than they were pre 2008. So we'll come on to see how Taylor Wimpey is done. But I think these are pretty good, and I think it's pretty fairly valued. And you've also got that very generous dividend yield there too. Sam, what are your thoughts on this statement from Persimmon?
I think it's pretty good. I don't have a huge amount to add other than I'm surprised because we've seen a few of these kind of results from house builders now. I'm surprised how quickly they've rebounded from the little
Mm,
wobble they had about a year ago. I thought it would take a bit longer, but they seem to have sort of bounced back within 12, 18 months, which I didn't
mm,
necessarily expect. It's just back to business, really.
fine. Okay, on to one of your favourites then.
Absolutely. So it is a stock that I own, Games Workshop. I think we covered the trading statement for these results, but the actual half year results are now out, and these are the half year results for the period that ended 1 December 2024. So core revenue was up 14.3% to 269.4 million. Licensing revenue was up 148% to 30.1 million, and overall revenue was up 21% to 299.5 million. Operating profit was up 21% to 126 million, and earnings per share was up 33.2% to 288.9p a share. There was a bit more detail in this, as you'd expect, than there was in the trading statement, but So they've said in the strategy part of the report, we have again remained focused on delivering our strategic goal to make the best fantasy miniatures in the world, to engage and inspire our customers, and to sell our products globally at a profit. We intend to do this forever. Our decisions are focused on long-term success, not short-term gains. Then it says a bit further down, cost increases are impacting most businesses in the UK. We, however, don't expect any material impact on our financial performance for the year to May 2025, following the UK's autumn budget 2024, e.g., increases to the national living wage, as we already pay all our UK staff as a minimum close to the new level. It may, however, drive third-party input cost increases in 2025-26. At this stage, we've not been informed of any significant changes. We await confirmation on any other external tariffs or tax changes, and we will manage them accordingly. Licensing. We own what we believe is some of the best underexploited intellectual property globally. In the period reported, a few notable games launched, including Warhammer 40,000 Space Marine 2 and Warhammer 40,000 Speed Freaks. After the period end, we concluded our negotiation with Amazon Content Services LLC, a subsidiary of Amazon.com, for the adaptation of the Games Workshop's Warhammer 40,000 universe into films and television series, together with associated merchandising rights. It then says, when they're going through segment by segment, for online decreased by 4.2% at actual exchange rates, 4% at constant currency rates. Excluding digital sales, online sales decreased by 12.2% at constant currency rates, which is broadly in line with our expectations following the Warhammer 40,000 release in June 2023. It's now been just over a year since we launched our new web store onto a more stable platform. The sales team, with the support of central IT, are now looking to continuously improve our customers' online experiences. This will, I promise, soon include additional payment options and changes to our navigation, making it easier for our customers to use the site. In the licensing revenue section, they've said that earned income was 26.1 million, and that's up from 5.9 million a year ago. The increase mainly being from Warhammer 40,000 Space Marine 2. I think this is quite interesting because it doesn't actually include the Amazon deal, because that was after the period end. So despite that massive increase, that's not got Amazon in, and it says that the total licensing receivables balance at the period end was 47 million, and that's up from 24.8 million. Total licensing revenue is split as follows: 98% PC and console games, 1% mobile, and 1% other. I suspect that mix will change significantly in the next set of results. They said later on, we still believe that North America has significant growth potential. We're currently on track to have 200 profitable stores by May 2025. Once this milestone is passed and they've finished celebrating, the team is ready to present their long list of potential new locations for the year ahead. And finally, I just thought it's worth giving a breakdown of the trade sales. So total trade sales were 165.7 million, and that's out of total revenue of 269 million. But of those trade sales, 74.7 million out of 165 is from UK and continental Europe. 69.8 million is now from North America, and that's up from 59 million a year ago. Australia and New Zealand's 9.6, and that's up from 8.1 a year ago. Asia's 8.1, and that's up from 7.3 a year ago. And then rest of the world is 2.3 compared to 2.2 a year ago. And then Black Library is 1.2 million compared to 1.2 million a year ago. In terms of valuation, the business did very well on the back of the results coming out, and it trades at a PE of 26.5 and has a yield of 2.58% at present. My views as shareholders, I'm very happy with these results. I think there's a lot to be excited about when you actually drill down in the detail compared to what was in the trading statement. I think particularly the Amazon figures not actually being in there yet, and the licensing revenue still being so good. North America is now nearly the size of the UK, and basically, from what they've said, it seems that the expansion is not planning to stop. So that will soon be the biggest segment, and will probably grow even further once the Amazon stuff starts coming out. So you've got different parts of the business reinforcing each other quite nicely. The only criticism I would have of this is, or the only criticism that I'd probably have, is it doesn't really sound like they're getting it done in terms of online. I think because of the type of the business, and a lot of people will go in store anyway, they're probably getting away with it because of the type of business it is. However, I think it would be nice if they could start turning around the online stuff, because I would expect online to be growing. And the fact that it's actually the stores that's kind of propping up online is, I wouldn't have actually expected that. John, as someone who's a bit less biased, what are your thoughts?
I mean, I think it's so far absolutely fantastic. And it does feel like the potential for the growth is huge, particularly with Amazon and the popularity increasing in the US, and on what is still a very small market cap, you'd have thought this could have a huge way to go. I suppose that is reflected in the valuation. Yeah, I would like to own shares in it, but I'm kind of anchored to the price that what you got in at, and I know I shouldn't be, and I should be looking forward, but I can't quite get over that. But no, I certainly don't think you can criticize this really at all. I mean, the point you that said, the point you make about stores and online is fair, but I think overall as a company,
Well, yeah, it's not exactly holding them back, is it, by
it,
the looks of it?
yeah, well, precisely. But yeah,
Um,
very, very good.
should we move back to our house builders then?
Yeah. So good, but probably a little bit less exciting. So Taylor Wimpey, which is a little bit bigger than Persimmon, they have their trading statement out again a couple of weeks ago, with Taylor Wimpey's full year average weekly net private sales rate in the UK rising by 21% to 0.75, alongside falling cancellation rates. The group completed 9,972 new homes in the UK in 2024, in line with guidance, but down from the 10,356 in the prior year. Average selling prices in the UK fell by 1.5% to £319,000, largely due to weakness in the south, where affordability has been most stretched. The order book grew 13% to £2 billion, and the net cash position fell from 0.7 billion to 0.6 billion, which was better than the prior group guidance. Full year operating profit guidance of around 416 million has been reiterated. Heading into 2025, Taylor Wimpey has seen an encouraging level of inquiries at the start of the year, and the group expects to see build costs rise due to the recent UK budget, but believes it's well positioned to deliver volume growth this year. And the shares were down around 2.6% in early trading. Interesting. I think some of those figures fairly similar. I mean, nearly on par with Persimmon. I think you're seeing some of the differences in that Taylor Wimpey is primarily in the south of England, although they do have a significant northern operation, and Persimmon is York based, so in the north. And I suppose that it's not completely elastic with the house prices, particularly with those higher interest rates, and that's clearly hitting Taylor Wimpey more than it is Persimmon. In terms of valuation, Taylor Wimpey has a market cap of 4.26 billion and trades at 0.92 times forward price to book, compared with a 10-year average of 1.5, and has prospective dividend yield of 8.4%. So yeah, I think it's a decent set of results, although I think the completions slightly more disappointing. I think you are seeing that north-south divide, and with those, well, the higher interest rate environment, that really stretching things to the limit in the south, which in Persimmon's case, being York-based and more in the north, you're not seeing that quite so much. I think it's very encouraging, though. As I said, with Persimmon, you're seeing things change in the cycle. And I think there is a huge demand in the whole of the UK, but particularly in the south. So I would imagine that it's going to be a bumpy ride, as I said before, but Taylor Wimpey, Persimmon, and most of the big house builders really benefiting from that structural imbalance. Sam, what do you have anything more to add?
So I'd probably just echo that they're not as good as the Persimmon results, I don't think, the Taylor Wimpey ones, but like you've pointed out, it's not really their fault 'cause it just seems to be because they have more of a presence in the south where the prices have fallen. I think it's a bit disappointing that the costs are going up and they can't offset that. So I think that is a bit of a shame. However, the margins are pretty decent. It would probably be nice to just have a little bit more of an idea of how much they think margins are going to be eaten into, but it's probably not a huge amount anyway. And if they think they're going to make up for it in volume growth in any case, they're probably doing everything they can. So as a shareholder, I think it'd be a bit disappointing, but also understandable.
Fair enough. Shall we move on to another stock that you own?
Yes, so this one is one that I newly own. fortunately. So I only bought it in the last few months. But Fevertree is a business that we've followed for a while and liked and watched the valuation drop and drop and drop. So Fevertree have come out with a full year trading statement, and they have seen revenue rise by 2% to 368 million, ignoring the impact of exchange rates. This was driven by double-digit growth in the US and the rest of the world, which helped offset declines in the UK. The group expects a strong uplift in underlying cash profit when it reports last year's results, and market expectations currently sit at around 50.8 million. For the 2025 year, revenue is expected to grow at a low single-digit rate, while increased marketing spend in the US will have a short-term impact on cash profits. However, in 2026, revenue and cash profits are both expected to grow at double-digit rates. This statement was, or the results themselves were slightly overshadowed by the announcement of a strategic partnership with Molson Coors, who have Coors beer, and that partnership is to help drive Fevertree's growth in the US. So Molson Coors have bought an 8.5% stake in Fevertree for 71 million, and Fevertree are going to return that to shareholders in the form of a buyback. And the shares were up 15% following this announcement. So the main benefit is that they're basically going to get access to Coors' marketing and
Distribution?
distribution, the network, contacts. So it gives Molson Coors enough of an interest that they want to see Fevertree succeed, and it gives them a bit of diversification away from beer, I guess, as well. So Fevertree is already the number one brand in the US for tonic and ginger beer categories, and that market has already grown to become larger than the UK market and is now the largest region. And it's still growing double digits. And Coors is actually the second largest US brewer. So I think their expertise is probably quite valuable. And both parties have agreed to substantial marketing investment to help elevate brand awareness further and drive sales following the investment. Additionally, Fevertree's diversified quite well in the last few years, so non-tonic mixers now represent around 42% of sales. In terms of the valuation, the business now trades at a forward PE of 23.7 compared to a 10-year average of 44.4. However, I would caveat that forward PE, although it's still fairly reasonably priced at 23.7, it's still on reduced earnings. It's still not got back to the earnings of, say, 2020, 2019. The prospective yield for the next 12 months is 2.3%, and that compares to a 10-year average of 0.9%. As a new shareholder, I'm very happy, mainly because I've sort of fluked into it very shortly before this announcement. However, I think it's only up around 15% on the back of this announcement. And when you look at how much it's fallen over the last few years, I don't think it sort of fundamentally changes whether or not it's a good opportunity or not. And I think if anything, this probably makes it more attractive for me. So I think the buyback I'm kind of indifferent to, because they don't need to use the cash for anything. I think they've just done it so that Molson Coors have a reason to be interested in the business. So the buyback, I suppose it'll be a nice bit, it'll be a nice bonus, but that's kind of it really. I'm fairly indifferent actually, but I think probably the benefits in terms of the distribution, the contacts, getting into sort of certain supermarkets or wherever else, I think that's going to be really, really valuable. And I think considering they're already doing a very good job in America, I think it's a lot to look forward to. And I think although the UK side is declining, I think the American market opportunity is so big. I'm not too concerned about it because I think it is, it's already starting to see that switch where actually America's growing more than enough to offset the UK. So I think you look at those historic figures from like say 2019, 2020, I don't see a reason why it can't get back to them. And I think if anything, I'm probably more optimistic than I was when I bought it because of this partnership. So I'm very happy with it. And the only caveat I would have is that I do wonder if in the next year or two, whether despite the initial optimism about this announcement, whether the shares might trickle back down a little bit, just because you are going to have that year or two, assuming everything goes to plan, where the earnings are taking a hit because of the marketing spend. And if that takes a little bit longer or whatever else, it might go back down. But then equally, it has fallen so much that I still think if you were to buy it now compared to before the announcement's made, you're still getting it at a very good price. And the business is probably more attractive anyway. So yeah, so I'm very happy with the results and the announcement. As someone who's less biased, what about you, John?
No, I think it's very good for the business. And as you say, I don't think it's going to be immediate that they're going to have, well, the turnaround. I think it's going to be, as you say, over the next year or two, probably more like two, before you really see it growing significantly. But I think it looks good, and I think it's very exciting, the progress that they're making in America. And I think that marketing spend will probably be well spent, in the business to grow it, and the right strategy there.
Right, should we move on to Experian then?
Yeah, so we haven't covered Experian for a while. We have done it in the past. It's a credit ratings agency specializing in credit reporting, so both consumer and business, data analytics, and identity verification. And it's one of the big three in the US alongside Equifax and TransUnion. And they had their Q3 statement out, and that was 2 weeks ago now. So the group delivered revenue growth of 8% over the third quarter, with underlying growth of 6%, and they're both ignoring currency moves. Growth was broad-based across geographies and business divisions, but came in slightly below expectations. Trends in the largest North American region are improving, whilst areas like Brazil are continuing to see strong consumer demand. Full year guidance is unchanged, looking for underlying revenue growth of between 6 and 8%, and the operating margin expansion at the upper end of the 0.3 to 0.5% range. And the shares were broadly flat in early trading. In terms of valuation, Experian has a market cap of £36.6 billion and trades at 24.5 times forward earnings, with a prospective dividend yield of 1.6%. I thought these results were slightly disappointing. It is fairly expensive in terms of as a stock. And I think for me, I know we've discussed it before, it is difficult to value. And certainly when you're not familiar with the industry, it's kind of one of those stocks that ends up probably going into the too hard pile. I know a lot of people do rate it as a very high quality UK stock, and it's probably quite difficult to put a value on a lot of the data that they have, alongside exactly just what they're selling to consumers and business, but how much that data can be monetized. So I think for me, it's probably a little bit too tricky. I would say on the surface of it, though, for those numbers, it certainly is quite pricey. Sam, what are your thoughts on Experian and this trading statement?
So I think it's a while since we covered it, like you said. I think in that time since we've last covered it, I've probably experienced the product a little bit more personally in terms of the credit score one and some of the data stuff they've got in terms of sort of tracking where your data is and whether it's been like breached or anything like that. So I, having experienced it a bit more personally over the last kind of 12, 18 months, I feel like I get it a little bit more. And I don't fully understand every part of the business, but I think in terms of the credit reporting and the identity verification, which I don't think I've dealt with them directly, but I think if it's similar to sort of any other AML, KYC stuff I've dealt with at work, it's going to be broadly similar. I think I kind of see the value of those, and I think they are quite sticky businesses and quite good businesses. The data analytics I struggle with a little bit more, but I guess there's kind of a logical follow on in that if they're collecting all this information about your credit report and your identity and stuff like that, that they are by nature going to have a lot of useful data on you and people like you that they can then sell to people, assuming that that is just what they're doing. So yeah, so although I think it's taken me a while to come around to it, but I think I probably am of the view that actually this is quite a high quality business. You then get to the size of it, it's a pretty big business already. I don't feel like I necessarily missed the boat though, because if you look at when we first started covering it on the show, it was pretty big then anyway. I think it was quite expensive then too. So I don't feel like it's taken me too long to understand it. I think it's just always been quite expensive as I've slowly come to understand it. But 6 to 8%, I think for a business of that size, I don't think it's actually terrible. I think it's quite a decent set of results. But the problem is when you're priced at a 25 forward PE, I'd probably expect more than 6 to 8%. And maybe you can argue there should be a bit of a premium because it's such a high quality business with quite sort of sticky revenue streams. But I just wouldn't be comfortable paying that for a business growing at that amount. So although I think I am now starting to warm to the business a little bit more, not really interested at all in that valuation with those kind of growth figures.
Okay. On to the final company of the week then.
Yes, so Netflix, it's one we like to cover fairly regularly, but Netflix have reported their fourth quarter results and revenue is up to $10.2 billion, which was up 19%, ignoring currency movements. They also saw a record of 19 million paid net additions compared to 13 million last year in terms of subscriber numbers, and operating income rose 52% to 2.3 billion, with operating margin improving from 17 to 22%. I'm actually surprised Netflix has an operating margin as high as 22%. I think that's a
Yeah.
higher quality business than I probably expected. Like, I don't think I expected it to get to those numbers. And I think it will go up and down with subscribers, but I think that is excellent.
Mhm.
Free cash flow fell 13% to 1.4 billion, and net debt ending 2024 is at 6.1 billion, which when you compare that to operating income of 2.3 billion just for the quarter, I think that's really good.
Mm.
Because a few years ago, you went back and the debt seemed quite high, but actually the business has done so well since. And the operating income, if your operating income's rising 52% a year, it will do that. But as a proportion of the income, it's now the debt's kind of stayed at a similar level, but the income's just shot up. They've done really, really well with that actually. But full year revenue for 2025 is expected to grow 14 to 17%, ignoring currency movements, to 43.5 to 44.5 billion, and the shares rose 14.7% in after hours trading. In terms of the valuation, the business trades at a forward PE of 35.9, and that compares with a 10-year average of 93. But I think that 10-year average is next to useless because it was a growth stock for most of that time. And I think you will now be seeing a lot lower growth for the next 10 years than you've seen for the past just because of the size of the business. It doesn't currently pay a dividend, but you'd start to be getting to the point now where it actually might do at some point. There's probably a prospect of one or if not buybacks. In terms of the share price, though, it's up over 50% in the last 12 months. In the last 3 years, I think it's like a four bagger, or not quite the last 3 years, but if you go from when it drops in sort of 2022, it's basically been a four bagger from when it bottomed, when it started having a little wobble when we were covering it. And it now trades at a market cap of $418 billion. I think these results are fantastic. I think you can't knock them. I think it's basically a perfect quarter, actually. I don't think there's anything that you can criticize in there. I think the strategy from management for the last few years has been excellent. I think in terms of just the debt, and I think they've probably had a vision of where the business has been going that I've maybe not been able to appreciate. And the market hasn't at times as well. Now, there was a point where you could have bought this quite cheap, certainly in hindsight. I think that was probably the opportunity to buy. I think, although these results are so impressive, I think if you look at that wobble it had 2 or 3 years ago, where the subscribers were kind of leveling out and dropping slightly, and the competition that it's now got from like Paramount and Disney and Hulu and whoever else, I think although Netflix is doing incredibly well and you can't really ask for any more as a shareholder, the issue is I think the market has still changed. And I think if Netflix has a couple of poor quarters in terms of the content that's coming out, they will see a drop off in subscribers. And then those subscribers will come back when they start putting out content that people want to watch again. Or they get like a couple of hits, like, Squid Game, for example. And I think it's going to be quite cyclical in that respect. Just for a while, I think that's going to be the nature of the beast. So I don't think it's going to be growing at the kind of levels sustainably to justify a forward P at 36. That being said, I think the business has done phenomenally well in terms of the way it's been operating. And I actually think, when it was at sort of 20, 25 times earnings and that was on reduced earnings a few years ago, I think there probably was quite a good opportunity there. But I wouldn't want to pay 36 times earnings because although it's grown at 19% for the year, I don't think it will grow 19% every year. And at 36 times earnings, it probably would need to actually. So what do you think, John?
I think it's done phenomenally well. Valuation, it is pretty toppy, but I suppose if you argue that they do have this in their locker, what they can deliver, then you might argue it's justified. But it would be, I can't imagine them doing this quarter after quarter, put it that way. So I probably wouldn't pay up for it. Don't mind owning it in my index fund
Well, that's good because you don't have an option.
though. Yeah, absolutely.
So
So
in terms of then the six businesses we've covered this week, Persimmon, Games Workshop, Taylor Wimpey, Fevertree, Experian, and Netflix. Which do you like the most and which do you like the least?
Good question. I think probably the most it's got to be Games Workshop, although valuation I have to come to terms with and ignore my anchoring. What do I like least? It'd probably be Experian. But I think actually the quality of the businesses this week is really high.
I would agree with that. I think it has been a strong week in terms of even Experian. The results were pretty good and it looks like a very good business. I think it's just a valuation issue. I think for me, I think top would probably be Games Workshop, although I am quite excited about the Fevertree results as well. But if you were going to put a gun to my head and force me to sell one, I'd probably part with Fevertree before I parted with Games Workshop. I think least favourite, I think I'd rather pay 36 times earnings for Netflix than 25 for Experian, given that Netflix does have those kind of growth rates potentially in the locker, even if it's not going to be every year. So yeah, so I think probably Experian on valuation, but it looks like an excellent business.
Very good. Well, on that note, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.